There are two aspects here. First is what we call as foreign currency transactions. Now, foreign currency transaction, what is foreign currency transaction? Whenever or when a company deals with another company. So think about company A, which is in country A, and company B, which is in country B. Now the thing is, if they are in different countries, the transaction will not be settled in the home currency. Like if an Indian company is dealing with Indian company, transaction will be settled in rupees. But if an Indian company, let's say company A, deals with US company, company B, the transactions will be settled in US dollars or Indian rupees. But let's for a moment assume US dollars. Then that becomes a foreign currency transaction. So if you understand, then this will become a foreign currency transactions. And the thing is, exchange rate will keep on changing. Please note it down. There are two portions here which have become important. So, say this. Please note it down. See this example. On 1st of October 2024, an importer from United States of America imported goods worth 10,000 euro. So the payment will be made in euros. That is a foreign currency for a US importer. The transaction will be settled on 31st of January 2025. The spot rates were as follow. What is spot rate? I think I have already discussed. The rate at which you buy or sell foreign currency today. Now, if you look at this, what does the rule says? You have recorded a purchase. Accounting has to be done in the books. So on the date, it's a credit purchase because cash is not getting paid. So you will have to debit purchase and credit accounts payable. The thing is, it is a US company. So your transactions ultimately in your books have to be recorded in dollars. But the transaction invoice is in euro. So we need a conversion rate to convert those euros into dollar. The rule says, see, there are three aspects of this accounting. First will be done on 1st of October 2024. That is the date of purchase or date of, you can say, transaction. Date when the transaction actually happens. The rule says convert the foreign currency using spot rate prevailing. I'll give you time to write on the date of the convert the foreign currency using spot rate that is prevailing on the date of the transaction. So on this date, this importer, assuming it is normal purchase, will have to pass a normal journal entry through the books. Purchase debit, trade payables, credit. Now the thing is, the bill is invoice is in euros. So that euros has to be converted into dollars. So if you understand, I have given $1 equals to 1.15 euro. So with $1, if you sell $1 on 1st of October, that is date of the transaction, you will get 1.15 euro. And if you want to buy $1 on the date of the transaction, you will have to sell 1.15 euro. This company needs this company is an importer. They have imported goods. So they will need to pay. So they need 10,000 euros. And of course, if you can understand, answer in dollars has to be less because dollar is more valuable than euro. So you have to divide. What is the
8,695.
8696
$95.65.
dollars? At this value, the company or importer's company will record the transaction in the books. Second thing is, now the transaction is not settled on the balance sheet date. I have intentionally put this because with this example, everything gets covered. That the transaction will be settled after the balance sheet date. So the rule is very simple. On the balance sheet date, you have to make sure there is a principle of conservatism. Asset should not be overstated, liability should not be understated. This is a liability payable. Now the thing is, you have to make this is what we call in market language as MTM, mark to market. So on the balance sheet date, if the transaction is unsettled, If it is settled by balance sheet date, then this entry is not required at all. But if the transaction is not settled by the balance sheet date, then the payables has to be marked to market. This is what we call as MTM in market terminology. Using spot rate on the date of the balance sheet, the transaction has to be marked to market using spot rate on the date of the balance sheet. See, balance sheet date, unless otherwise mentioned in the question, it's a US company. So it always has to be 31st of December. The date of transaction was 1st of October. So I used that date spot rate, the date of transaction. Now here balance sheet date is 31st December. So again I will use that date spot rate. All this is done assuming this is only applicable, this accounting, if the transaction is not hedged, if hedging is not done. In part 2, corporate finance only, we will discuss hedging. When you eliminate your exposure or eliminate your risks in this movement. See, here the importer has not hedged the risk at all. The rate can go up or down, and this affects the importer directly. If it is hedged, the rate is generally locked. Then there is no effect on importer whatsoever. But this accounting is applicable only if the transaction is not hedged. This is also there in CPA. In foreign currency accounting, same thing we teach, assuming transaction is not hedged. So on this date, I need to adjust my accounts payable. First, I need to calculate the value of the payables in dollars. Euros I have to pay. That is not changing. Only thing changing is dollars, that is home currency, because foreign currency is constant here. If it was home currency, then it was not a problem at all, because US dollars only the company will have to pay. This all accounting is coming because it is a foreign currency transaction. So trade payables value as on the balance sheet date. So again, you have to remember that 10,000 euros, this is not changing, and you have to divide because $1 is 1.125. So 1.25, what's the value? 8,000. If you understand, that means on this date, if company pays $8,000, it will be able to buy, sorry, if company sells $8,000, it will be able to buy the 10,000 euros needed to settle the transaction. On the date of the transaction, the company needed to sell $8,696 to buy the same amount of euro. But on the balance sheet date, it will need to sell only $8,000 to buy 10,000 euros. Dollar has gained in value. I am linking corporate finance with this. This also means dollar has appreciated, because with less amount of dollars, you can buy the same amount of euro. So in this case, accounts payable was recorded at 8696, but the value is relevant for only 8,000. So I have to reduce the value by $696. Now, trade payables is a liability account. How do you reduce a liability account? By debiting the same. When I pass this entry, automatically the value of trade payables in the balance sheet becomes 8,000. And the difference in the credit side is called as foreign exchange gain. If you follow the golden rule of accounting, gains are always credit. Now, third entry is passed on the date of settlement. On the date, the cash is actually paid. Again, same thing. Now, here on this date only, you will go to buy the euros. So, on this date, whatever is the rate, that is the actual dollars you have paid. So spot rate, the porter, the party on the other side. So this is the rate used to settle the transactions. In this case, accounts payable is 8,000. Last known carrying value of the accounts payable was 8,000. First, let's look at what's the rate. Rate is 31st of, okay, I think we can have it here. Rate is 1.10. Again, it has fluctuated. So how many dollars are required? This is the dollars that will actually be bought to settle the transaction. But remember, your accounts payable you have only recorded with 8,000. So trade payables debit 8,000. This is the last carrying value of the liability on the balance sheet. Cash will be credited. This is the dollars you have actually spent on purchasing. Difference is a debit. This is a loss because between the balance sheet date and the date of settlement, dollar reduced in value. So it created a foreign currency exchange loss. Debit, the balancing figure, 1110. This is it about foreign currency transaction. There is nothing more here. Is it clear? Now please note it down. This is what we call as foreign currency accounting. This is actual when transaction has happened. There is also an accounting for translation and there is also an accounting for remeasurement. We will also discuss that during using different methods. So that's it for today. Thank you.